Goldman didn't just cut U.S. growth forecasts, also for China, also for oil demand. Yet you're also looking for the S&P to gain at least 7% before the year's out. So how does all that square?
Well, Martin, really, it's a function of the underlying, for the S&P specifically, it's a function of the underlying earnings, which have been very, very strong in the second quarter. And David Costin, our chief U.S. strategist, has increased his numbers for both this year and slightly more for next. So I think the key number for S&P 500 EPS is we've gone from $202 a share to 211. So number one, our earnings are somewhat higher, and then number two, given the fact that we think that interest rates will still stay lower for longer, we've actually taken our U.S. 10-year forecast down from 1.9 to 1.6% this year. So lower interest rates are obviously very supportive for valuations. So we think that combination of higher earnings and lower rates will be supportive for the equity market. I think there's probably a third factor, which is that at the margin, the U.S. is now looking more like a safe haven market. And obviously, there's been some signs that we picked up here in Asia of a redeployment of funds from China to either other parts of the region, be it Japan, Korea, Taiwan, India, or indeed back to the United States. So I think that the combination of those three factors for the U.S. specifically can help support a 4,700 S&P 500 year-end target.
47 by the end of the year for SPX. Let's focus in on how the Fed plays into it, Tim, if we could. You mentioned a couple of seconds ago your year-end target for the 10 now is not 1.9. You've taken it down to 1.6. This must assume there's this growing consensus now that there's going to be a difference between the Fed talk and the Fed walk on taper. Are you looking at not September, maybe November, maybe December before that is clear in terms of execution, taper?
Well, our U.S. economists have, in light of the recent Fed minutes, have slightly adjusted the subjective probabilities around when we might see some indication of Fed tapering being announced. And so we think there's a slightly higher probability now than just before that we would get some sort of an announcement in November, as opposed to our previous expectations. We still think the actual taper starts early next year and will go roughly around the tune of about 15 billion per month, if my memory serves correctly. But we are still somewhat more dovish about when the Fed would actually start to increase policy rates, and still think that would be somewhere towards the latter part of 2023. And I guess the key reason there is that we're looking for for inflation to actually be much more transitory. A, because of waning used vehicle prices. B, because of the erosion of the support that is keeping some people out of the market. So we think there'll be sort of a positive labor market supply issue. So those are among some of the issues that suggest to us, along with base effects, that we probably would see inflation be less of a concern than market might be currently fearing.